The concept of credit emerged from simple bartering systems in ancient civilizations. It allowed for the delayed exchange of goods and services based on mutual trust. This informal system relied heavily on an individual's personal reputation. Community knowledge played a crucial role in validating trustworthiness for these exchanges. As early agricultural societies grew in complexity, new economic needs emerged. Farmers often required essential resources like seeds or tools before harvest. This led to borrowing from neighbors, with repayment promised after the harvest. This practice established an early form of agricultural credit. Such credit was crucial for managing seasonal production cycles and ensuring food supply. The earliest documented records of lending originate from ancient Mesopotamia. These records were meticulously inscribed on durable clay tablets. The tablets detailed loans of commodities such as grain and silver. They specified terms of repayment and interest, formalizing credit transactions. In ancient Rome, moneylenders were an integral part of the economic landscape. They openly provided financial loans to both merchants and private individuals. This practice facilitated commerce and supported personal financial needs. The Roman legal system began to address the complexities of debt. Rules were established to govern lending and borrowing activities. This included defining consequences for non-payment, marking an evolution in credit regulation. During the Middle Ages, credit and lending were essential for economic activity. Pawnbrokers emerged as key figures, providing loans against valuable collateral. These loans were often crucial for individuals and small businesses. Guilds also played a significant role, offering credit to their members. This support helped members manage finances and grow their trades. The era saw the development of more structured lending practices within communities. The Renaissance era in Italy saw the emergence of sophisticated banking houses. These institutions played a crucial role in facilitating the growth of international trade. They introduced financial instruments like letters of credit and bills of exchange. These innovations enabled transactions to occur without the need for physical currency. The Industrial Revolution created an unprecedented demand for capital to fuel its rapid expansion. This era saw the significant growth and evolution of commercial banks. Commercial banks played a crucial role by providing essential loans to businesses. These loans were vital for businesses to invest in new machinery and expand operations. Consequently, the scope and scale of credit mechanisms broadened dramatically during this period. In the 19th century, consumer credit operated on a localized, personal basis. Local merchants directly extended credit to their established customer base. This system fostered a direct relationship between seller and buyer regarding financial transactions. Merchants meticulously maintained ledger books to record all purchases made on credit. These ledgers also tracked subsequent payments, ensuring accurate account management. This method represented a fundamental form of consumer credit, built on trust and personal accountability. Early 20th century department stores revolutionized retail practices. A key innovation was the introduction of charge accounts for customers. These accounts allowed shoppers to make purchases without immediate payment. Customers could defer payment, settling their balance at a later date. This marked a significant shift towards formalized consumer credit. Retailers began offering structured credit options directly to their patrons. The post-World War II era saw a significant economic boom in the United States. This prosperity fueled a substantial surge in consumer demand for various goods. Consumer credit became essential for purchasing major items like homes, automobiles, and appliances. This period normalized widespread consumer borrowing, fundamentally changing economic behavior. The year 1950 marked a significant milestone in the history of payment systems. The Diners Club introduced the world's first universal credit card. This innovative card allowed members to pay for meals at various establishments. It revolutionized payment methods, setting the stage for modern credit card use. The Bank AmeriCard, a pioneering bank-issued credit card, was launched in 1958. This card later evolved into the globally recognized Visa credit card network. MasterCard followed, being introduced to the market in 1966, expanding credit access. These innovations made revolving credit widely accessible to a broader consumer base. The expansion of credit necessitated a centralized system for borrower information. Early credit bureaus emerged to fulfill this need. collecting financial data. They gathered information from local merchants and banking institutions. This data was then compiled into rudimentary credit histories for individuals. Historically, credit information was managed through physical files and index cards. These physical records contained essential data for credit assessment. Retrieval of this information was a manual, labor-intensive process. Each credit application required individual file access and review. This manual system was inherently prone to inconsistencies in data and assessment. Such methods posed significant challenges for efficient and accurate credit evaluation. The mid-20th century marked the advent of computer technology. This innovation enabled credit bureaus to automate data storage and retrieval processes. Automation significantly improved the efficiency of handling credit information. It also enhanced their capacity to process large volumes of data effectively. Early computerized systems marked a significant step in data management. These systems initially relied heavily on extensive manual data entry processes. Despite manual input, they established the foundational infrastructure. This groundwork enabled the development of sophisticated credit reporting mechanisms. Credit bureaus historically collected financial data from various sources. Over time, these bureaus began to consolidate their data collection processes. This consolidation aimed to standardize the information gathered. The goal was to create more comprehensive and accurate borrower profiles. Lenders evaluate the creditworthiness of loan applicants to make informed decisions. This assessment relies on information obtained from credit bureaus. Credit bureau data provides insights into an applicant's financial history. Based on this data, lenders determine loan approvals and set interest rates. Historically, this assessment process often involved a degree of subjective judgment. Before the introduction of FICO scores, credit assessment relied on different methods. Lenders often used their own proprietary scoring models to evaluate creditworthiness. Decisions were also made through qualitative reviews of individual credit reports. This led to inconsistent standards and potential biases in lending decisions. In 1956, Bill Fair and Earl Isaac established Fair, Isaac and Company. This company later evolved into the globally recognized FICO. Their primary objective was to create a standardized method for credit risk assessment. The goal was to develop an objective and consistent approach to evaluating creditworthiness. Fair and Isaac pioneered the application of statistical analysis to consumer credit data. Their objective was to identify patterns within this data that indicated repayment behavior. This analytical approach allowed them to discern reliable indicators of financial responsibility. They subsequently developed sophisticated algorithms based on these identified patterns. These algorithms were designed to accurately quantify and assess individual credit risk. This methodology formed the foundation for modern credit scoring systems, widely used today. The first FICO score was introduced in 1989, marking a significant milestone in credit assessment. This innovation provided a standardized, three-digit numerical representation of a consumer's credit risk. Prior to FICO, credit evaluations were often subjective and inconsistent across lenders. The FICO score offered an objective and uniform metric for assessing borrower reliability. Its introduction revolutionized the process of credit decision-making for financial institutions. This standardized score enabled faster, more efficient, and fairer credit evaluations globally. FICO scores are a critical measure of an individual's creditworthiness. These scores are derived from 5 primary categories of financial data. Key categories include payment history, reflecting past repayment behavior. Amounts owed and length of credit history also significantly influence the score. New credit applications and the diversity of credit mix are also factored in. Each category contributes a specific percentage to the overall FICO score calculation. Payment history is a critical component in determining an individual's FICO score. It is the most significant factor, accounting for 35% of the total FICO score calculation. This category evaluates an individual's track record of repaying debts. Consistent on-time payments demonstrate financial reliability and responsibility. Such positive payment behavior directly contributes to a higher FICO score. Conversely, late or missed payments can negatively impact the score, signaling higher risk. Credit utilization, or amounts owed, is a significant factor in determining an individual's credit score. This category typically accounts for 30% of the overall credit score calculation. It measures the amount of credit you are using compared to the total credit available to you. Maintaining low credit card balances relative to your credit limits is crucial. This practice demonstrates responsible credit management to lenders and credit bureaus. A lower utilization rate generally indicates a reduced risk of default, positively impacting your score. The length of credit history is a significant factor in determining an individual's credit score. It accounts for approximately 15% of the overall credit score calculation. This factor evaluates the duration for which credit accounts have been active. It also considers the average age of all open credit accounts. A longer credit history generally indicates more experience managing debt responsibly. Consequently, individuals with longer credit histories tend to achieve higher credit scores. New credit applications are a factor in credit scoring models. This category typically contributes around 10% to an individual's overall credit score. Opening multiple new accounts in a short time frame can signal increased financial risk. Such activity may lead to a reduction in the credit score due to perceived higher risk. Credit mix evaluates the diversity of an individual's credit accounts. It includes various types such as installment loans, revolving credit, and mortgages. A varied credit portfolio indicates an individual's ability to manage different debt forms. This diversity is a factor in assessing financial health and creditworthiness. Lenders employ FICO scores as a critical tool in evaluating loan applications. FICO scores provide a rapid and objective assessment of an applicant's creditworthiness. This standardized scoring system significantly streamlines the loan approval process. It ensures a consistent evaluation framework is applied across all potential borrowers. The objectivity of FICO scores helps reduce bias in lending decisions. Ultimately, FICO scores facilitate efficient and equitable access to credit for applicants. Consumers can access their FICO scores to understand their creditworthiness. A FICO score is a numerical representation of an individual's credit risk. Accessing this score helps identify specific areas for financial improvement. This process empowers individuals to proactively manage their financial health. Understanding FICO scores is crucial for making informed financial decisions. FICO scores are a standard measure of an individual's creditworthiness. These scores typically fall within a range of 300 to 850. A higher FICO score indicates a lower credit risk for lenders. Conversely, lower scores suggest a higher risk of default. This standardized range provides a clear benchmark for financial institutions in assessing credit applications. Subprime lending targets individuals with lower FICO scores, indicating a higher credit risk profile. These borrowers often face more stringent loan terms due to the perceived elevated risk. Higher interest rates are a common characteristic of subprime loans to compensate lenders for risk. This lending segment provides credit access to those who might otherwise be denied traditional loans. In the financial landscape, borrowers are categorized based on their creditworthiness. Those with excellent FICO scores are identified as prime borrowers. This designation reflects their strong credit profiles and history of responsible financial behavior. Prime borrowers are eligible for the most favorable interest rates available in the market. They also qualify for advantageous loan conditions, including longer terms and lower fees. This preferential treatment is a direct result of their perceived low risk to lenders. In the early 20th century, credit misuse was a significant financial issue. Individuals often overextended themselves by accumulating multiple merchant accounts. This practice frequently led to widespread defaults on their financial obligations. Such overextension resulted in considerable financial distress for many. In the 1970s, credit cards became increasingly prevalent in daily transactions. This rise in usage, however, coincided with a significant increase in credit card fraud. Fraud often involved the use of stolen physical cards for unauthorized purchases. Identity theft also emerged as a method, allowing criminals to open accounts or make purchases. These fraudulent activities resulted in substantial financial losses for both consumers and lenders. Personal bankruptcy often results from the widespread misuse of credit. This includes taking on excessive debt that individuals cannot repay. Such financial distress directly impacts the individuals involved. It also has broader negative consequences for the overall economy. Economic recessions expose inherent vulnerabilities within credit systems. During these periods, job losses become more prevalent, impacting household incomes. Reduced income directly leads to an increase in loan default rates among consumers. This surge in defaults exacerbates credit problems across the financial sector. Predatory lending involves offering loans with unfair or abusive terms to borrowers. These practices often target vulnerable individuals who may have limited financial literacy. Lenders may impose exorbitant interest rates, hidden fees, or misleading clauses. Such loans exacerbate financial difficulties, trapping borrowers in cycles of debt. The 2008 subprime mortgage crisis was a significant global financial event. It originated from widespread misuse of credit and inadequate lending standards. Lax lending practices allowed high-risk borrowers to obtain mortgages. This led to a surge in mortgage defaults and foreclosures across the market. The crisis demonstrated how systemic risks can trigger global financial instability. The proliferation of digital transactions has significantly elevated the risk of identity theft. This increase in risk necessitates the implementation of enhanced security measures. Robust consumer protection laws have been developed to combat this growing threat. These measures aim to safeguard personal information and financial assets in the digital age. Large-scale data breaches have become a significant concern in the digital age. These incidents often occur at credit bureaus or major financial institutions. Sensitive consumer information, including personal and financial data, is exposed. Such breaches lead to widespread calls for enhanced data security measures. They also highlight the critical need for greater accountability from organizations handling sensitive data. Efforts to combat credit misuse are being strengthened through comprehensive strategies. A key component involves extensive consumer education campaigns. These campaigns focus on teaching essential financial literacy skills. They also promote responsible credit management practices among consumers. Credit counseling services assist individuals facing financial difficulties and debt. These services provide expert guidance and support to manage and resolve debt issues. A key component is personalized budgeting advice, helping clients track income and expenses. Counselors also offer strategies for debt consolidation, simplifying multiple debts into one. They develop structured repayment plans, often negotiating with creditors on behalf of clients. The goal is to empower individuals to achieve financial stability and reduce their debt burden. Credit misuse can lead to significant financial instability and consumer vulnerability. Governments and regulatory bodies acknowledge the critical need to address these issues. Their primary response involves implementing stricter lending regulations to control credit access. These regulations aim to prevent predatory practices and ensure responsible credit issuance. Additionally, consumer protection laws are enhanced to safeguard individuals from exploitation. Consumers have established mechanisms to dispute inaccurate information on their credit reports. These mechanisms ensure fairness in the credit reporting system. They also guarantee the accuracy of reported credit data. The dispute process allows individuals to challenge errors or discrepancies. This system upholds the integrity and reliability of consumer credit information. The credit repair industry has expanded to assist consumers in improving their credit scores. These companies offer services aimed at enhancing an individual's creditworthiness. While many operate legitimately, some credit repair companies engage in questionable practices. Consumers should exercise caution and verify the reputability of such service providers. Credit monitoring services have gained prominence as a vital tool for consumer financial protection. These services continuously track changes and activities within an individual's credit reports. Users receive timely alerts regarding any modifications or new entries on their credit profile. This proactive notification system is crucial for identifying potential fraudulent activities early. It empowers consumers to take immediate action, safeguarding their financial identity and credit health. Fintech companies are at the forefront of financial innovation, reshaping traditional services. They have introduced a range of innovative credit products and services to the market. These innovations often challenge and disrupt established, traditional lending models. The rapid evolution of fintech necessitates new approaches to regulatory oversight. Regulators must adapt to ensure consumer protection and financial stability in this evolving landscape. This balance between innovation and regulation is crucial for the sustainable growth of fintech. In the late 19th and early 20th centuries, credit reporting began to emerge. Numerous small, local agencies were established to collect financial information. Each agency operated within its specific geographic area. These agencies gathered data to assess the creditworthiness of individuals and businesses. Initially, numerous smaller agencies operated independently within the credit reporting industry. These agencies collected and managed credit data for specific regions or client bases. Over time, a trend of consolidation began to emerge among these entities. Smaller credit bureaus started to merge with or be acquired by larger organizations. This consolidation was primarily driven by the need for broader data coverage. It also aimed to achieve more efficient and streamlined data management processes. Equifax, a major credit reporting agency, was established in 1899. It was originally known by the name Retail Credit Company. The company's initial operations focused on collecting credit information. This data was gathered on consumers to assist local merchants with credit decisions. Over time, Retail Credit Company expanded its services beyond local markets. This expansion led to the development of a national presence in credit reporting. Experian's origins trace back to the establishment of TRW Information Services in 1980. TRW Information Services laid the foundational groundwork for what would become Experian. Over time, the company underwent a transformation, eventually rebranding as Experian. Its growth trajectory was significantly shaped by strategic acquisitions of other entities. Technological advancements also played a crucial role in expanding its capabilities and market reach. These factors combined to build Experian into a leading global information services company. TransUnion was established in 1968, marking its inception as a corporate entity. Initially, the company functioned as a holding entity for a railcar leasing business. This original business model focused on asset management within the transportation sector. However, TransUnion quickly recognized opportunities for expansion and diversification. Through strategic acquisitions, it rapidly ventured into the credit reporting industry. This pivotal shift transformed TransUnion into a major player in financial information services. The credit reporting industry has consolidated into three major bureaus: Equifax, Experian, and TransUnion. This consolidation was primarily driven by the principle of economies of scale. Economies of scale occur when increased production leads to decreased per-unit costs. For credit bureaus, this means that collecting and processing vast amounts of data becomes more efficient. Larger operations allow for the spread of fixed costs over a greater volume of data. This makes data collection and processing significantly more cost-effective for these large entities. Maintaining a national database of credit information is a complex and resource-intensive undertaking. It demands substantial infrastructure to store and process vast amounts of sensitive financial data securely. Significant resources are required for continuous data collection, validation, and system maintenance. Such an intricate system necessitates robust technological frameworks and expert personnel. Only large, consolidated entities possess the capacity to effectively manage these extensive requirements. The consolidation into fewer, larger credit bureaus streamlined operations. This facilitated the standardization of credit reporting formats across the industry. It also led to the establishment of consistent data definitions for credit information. Such standardization made it easier for lenders to interpret credit reports. Lenders could then consistently assess creditworthiness, improving efficiency. Regulatory oversight is more efficient when focused on a limited number of major entities. Monitoring three major bureaus is simpler than hundreds or thousands of smaller ones. This concentrated approach streamlines compliance processes for regulatory bodies. It also enhances the effectiveness of enforcement actions due to reduced complexity. 3 credit bureaus established data sharing agreements. These agreements were developed with lenders across the entire country. The purpose was to gather extensive consumer credit data. This collaboration ensured a comprehensive view of credit behavior. Such agreements are crucial for assessing financial risk. They provide insights into borrowing and repayment patterns. Despite a limited number of major national credit bureaus, they operate in a competitive market. These bureaus actively vie for business from various lenders. They differentiate themselves by offering a range of distinct services. This competition drives innovation and service quality within the industry. Beyond the major credit reporting agencies, specialized credit bureaus operate within specific industries. These bureaus cater to niche sectors such as medical services or tenant screening. They collect and provide data relevant to their specific industry's credit assessment needs. However, these specialized bureaus do not offer comprehensive consumer credit reports. Lenders regularly report consumer credit activity to major credit bureaus. These bureaus compile the reported data into comprehensive credit reports. They also calculate FICO scores based on this collected credit information. This process establishes a continuous and dynamic flow of credit data. Federal law mandates consumer access to credit reports. Consumers are entitled to a free annual credit report. These reports are available from each of the 3 major bureaus. This ensures transparency and allows consumers to check for errors. Before formal credit laws, consumers faced significant challenges in financial transactions. There was limited legal recourse for individuals against unfair lending practices by creditors. Consumers also lacked protection from inaccurate or misleading credit information. This absence of regulation led to a high degree of consumer vulnerability in the market. The lack of established legal frameworks exposed individuals to potential exploitation. The Great Depression revealed critical vulnerabilities within the global financial system. It highlighted the inherent fragility of banking and investment structures. Widespread defaults became a significant threat to economic stability. This crisis underscored the urgent necessity for enhanced financial regulation. Such regulations were crucial to safeguard consumers from economic collapse. Ultimately, the Depression mandated stronger oversight to protect the broader economy. The Fair Credit Reporting Act, FCRA, was enacted in 1970. It stands as the first major federal law to regulate consumer credit information. The FCRA governs the collection of consumer credit data. It also regulates the dissemination of this sensitive financial information. Furthermore, the Act controls how consumer credit information is used. A primary objective of the FCRA is to establish and protect consumer rights regarding credit data. The Fair Credit Reporting Act, FCRA, grants consumers significant rights regarding their credit information. Consumers have the right to access and know the contents of their personal credit files. They can dispute any inaccurate information found within their credit reports. FCRA also mandates the removal of outdated negative information from credit files. Furthermore, the Act imposes strict restrictions on who can access consumer credit reports. The Equal Credit Opportunity Act, ECOA, was enacted in 1974. Its primary purpose was to prohibit discrimination in credit transactions. This includes discrimination based on race, color, and religion. It also covers national origin, sex, and marital status. Furthermore, discrimination based on age is prohibited by the ECOA. The Act was designed to ensure fairness and equality in credit access for all. The Equal Credit Opportunity Act, ECOA, was enacted to ensure fair lending practices. Its primary goal was to prevent discrimination in credit decisions. ECOA mandated that credit decisions be based solely on an applicant's creditworthiness. It prohibited lenders from considering discriminatory factors such as race, gender, or religion. This legislation significantly expanded access to credit for previously marginalized groups. ECOA fostered a more equitable financial landscape by promoting fair and unbiased lending. The Fair Debt Collection Practices Act, FDCPA, was enacted in 1977. It addresses and regulates abusive debt collection practices by third-party collectors. The FDCPA protects consumers from harassment, false statements, and unfair practices. Its primary goal is to ensure ethical and lawful conduct within the debt collection industry. The Fair Debt Collection Practices Act, FDCPA, regulates debt collection activities. It establishes clear guidelines for how debt collectors must interact with consumers. The FDCPA aims to eliminate abusive practices by debt collectors. It ensures fair treatment for consumers in the debt collection process. Consumers who experience violations of the FDCPA are provided with legal remedies. These remedies allow individuals to seek redress for unlawful debt collection actions. The Truth in Lending Act, TILA, was enacted in 1968 to protect consumers in credit transactions. It mandates that lenders disclose the true cost of credit to potential borrowers. Key disclosures include the annual percentage rate, APR, which reflects the total cost of borrowing. Other essential loan terms, such as finance charges and payment schedules, must also be provided. This transparency empowers consumers to make informed decisions before committing to a loan. TILA applies to various credit types, including mortgages, credit cards, and auto loans. The Truth in Lending Act, TILA, established key requirements for credit disclosures. TILA mandated that credit terms be presented in a clear and conspicuous manner. This clarity ensures consumers can easily understand the conditions of their loans. The primary goal is to enable effective comparison of credit offers from different lenders. Such transparency empowers consumers to make informed financial decisions. The Credit Card Accountability, Responsibility, and Disclosure Act was enacted in 2009. This legislation introduced significant reforms to credit card industry practices. A primary goal was to protect consumers from arbitrary interest rate increases. It also aimed to prevent the imposition of excessive fees by credit card companies. The CARD Act enhanced consumer rights and transparency in credit card agreements. The CARD Act implemented key protections for credit card consumers. It limited universal default, preventing interest rate hikes on unrelated accounts. The Act mandated clearer billing statements for enhanced transparency. It restricted credit card issuance to young adults, aiming to prevent debt traps. The Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in 2010. This landmark legislation aimed to reform the financial system and protect consumers. A key outcome was the establishment of the Consumer Financial Protection Bureau, CFPB. The CFPB is a federal agency dedicated to safeguarding consumers in the financial marketplace. The Consumer Financial Protection Bureau, CFPB, plays a crucial role in safeguarding consumers. It is responsible for enforcing federal consumer financial laws. The CFPB actively investigates consumer complaints to address financial misconduct. It also educates consumers on financial products and services, empowering informed decisions. These actions ensure fairness and transparency within credit markets, benefiting all consumers. New laws have significantly transformed the credit landscape for consumers. These regulations have enhanced transparency within the credit system. They have also fostered fairer and more accessible credit opportunities. Crucially, these laws provide essential protections for American consumers. Access to credit is not universally mandated for every American citizen. However, specific laws are in place to ensure credit availability. These regulations guarantee that all eligible individuals can access credit. Crucially, these laws prohibit any form of discrimination in credit provision. The primary goal is to promote broader financial inclusion across the population. The earliest forms of credit emerged from informal agreements within small communities. These systems relied heavily on mutual trust among individuals. Goods or services were exchanged with an understanding of deferred payment. This foundational barter system laid the groundwork for future credit concepts. Written contracts for loans originated in ancient civilizations. Early examples are found in Sumer and Babylon. These contracts were inscribed on cuneiform tablets. They meticulously recorded details of debt. Repayment terms were clearly stipulated. This marked a significant transition to formal credit systems. During the medieval period, merchants played a crucial role in economic transactions. They frequently extended credit to customers, enabling purchases without immediate payment. These credit transactions were meticulously recorded, often in ledgers, for accountability. This system significantly facilitated trade and consumption within local economies. Promissory notes emerged as crucial financial instruments in the 18th century. These documents formalized personal loans, providing a written record of debt. They also served to formalize trade credit, facilitating commercial transactions. Each note contained a promise to pay a specific sum of money. This payment was contractually obligated to occur by a certain agreed-upon date. Promissory notes thus standardized financial agreements, enhancing trust and efficiency. The 19th century marked a significant shift in consumer purchasing habits. This era saw the emergence and popularization of installment plans. These plans allowed consumers to acquire durable goods, such as furniture and sewing machines. Instead of a single upfront payment, the cost was spread over a period of time. This innovation made expensive items more accessible to a broader range of the population. In the early 20th century, department stores introduced charge accounts. These accounts offered customers a convenient method to make purchases without immediate cash payment. This system allowed customers to consolidate their spending with a single retailer. Charge accounts facilitated easier transactions and fostered customer loyalty. The mid-20th century marked a pivotal shift in payment systems, particularly for travel and entertainment. The introduction of specialized cards, such as Diners Club, revolutionized how consumers paid for services. These early cards offered a convenient alternative to cash for dining, lodging, and other leisure activities. They facilitated transactions by allowing customers to consolidate expenses into a single monthly bill. This innovation streamlined financial interactions for both consumers and businesses. These travel and entertainment cards served as a crucial precursor to the modern credit card system. In the 1960s, bank-issued credit cards emerged, revolutionizing consumer finance. Cards like Bank Americard and MasterCard significantly expanded access to credit. They introduced the concept of revolving credit, allowing continuous borrowing. These cards gained broad acceptance across various merchants, increasing their utility. The 1970s marked a significant period for credit bureaus, characterized by rapid expansion. This era saw the widespread adoption of computerization within these financial institutions. Computerization enabled credit bureaus to process information with unprecedented speed and scale. They began collecting and managing vast amounts of consumer data more efficiently than ever before. This technological shift fundamentally transformed how credit information was handled and utilized. The 1980s marked a pivotal era in financial risk assessment. This decade saw the significant development of statistical credit scoring models. These models were designed to evaluate an individual's creditworthiness systematically. A key outcome was the creation of the FICO Score, a widely adopted standard. The FICO Score standardized credit risk assessment, impacting lending practices globally. The 1990s marked a pivotal period for FICO scores in the financial industry. During this decade, FICO scores achieved widespread adoption among lenders. They rapidly became an industry standard for assessing an applicant's creditworthiness. This standardization significantly streamlined the loan approval process for financial institutions. The widespread use of FICO scores transformed how credit risk was evaluated. The 2000s marked a significant internet revolution, transforming various sectors, including finance. This era introduced unprecedented convenience for consumers seeking credit. Online platforms streamlined the process of submitting credit applications. Accessing personal credit reports also became significantly easier through digital channels. These advancements fostered greater financial engagement and accessibility for individuals. The 2008 financial crisis exposed significant vulnerabilities within the global financial system. In response, governments initiated comprehensive regulatory reforms to prevent future crises. A key example is the Dodd-Frank Wall Street Reform and Consumer Protection Act in the U.S. These reforms aim to enhance consumer protection against predatory financial practices. They also sought to stabilize the financial system by increasing oversight and accountability. The reforms introduced stricter rules for banks, derivatives, and credit rating agencies. Consumers today have access to various tools for monitoring their credit. These resources include free annual credit reports, providing a comprehensive overview. Real-time alerts offer immediate notifications of any changes or suspicious activity. Such tools empower individuals to actively manage and protect their financial identity. The future of credit assessment is being reshaped by technological advancements. Artificial intelligence, AI, is increasingly central to evaluating credit risk. AI systems analyze vast data sets to identify patterns indicative of creditworthiness. Alternative data sources, beyond traditional financial records, are also being utilized. These new data points provide a more comprehensive view of an applicant's financial behavior. This approach has the potential to expand credit access for previously underserved populations. Credit markets are experiencing increasing globalization, linking economies worldwide. This integration involves the flow of credit and capital across international borders. International credit reporting systems are vital for assessing borrower risk globally. Cross-border lending facilitates access to capital for businesses and individuals. However, this interconnectedness introduces new challenges, such as regulatory complexities. Despite challenges, it also creates significant opportunities for economic growth and diversification. Digital currencies are emerging as a transformative force in the global financial landscape. Underpinning these currencies is blockchain technology, a decentralized and secure ledger system. This innovation is poised to introduce new paradigms for credit and lending mechanisms. It offers the potential to decentralize traditional financial systems, reducing reliance on intermediaries. This shift could lead to more efficient, transparent, and accessible credit services worldwide. The integration of digital currencies may redefine how creditworthiness is assessed and managed. Credit serves as a vital engine for economic growth and development. It enables individuals to make significant investments, such as purchasing homes. Credit also facilitates access to education, fostering human capital development. For businesses, credit provides the capital necessary for expansion and innovation. This financial mechanism consistently drives economic activity and progress. The evolution of credit involves continuous refinement of risk management techniques. Historically, credit assessment relied on subjective evaluations. These subjective methods were often prone to bias and inconsistency. Modern credit risk management has transitioned to sophisticated data-driven models. These models utilize vast datasets and advanced algorithms for precise analysis. This shift enhances accuracy and objectivity in assessing creditworthiness. Consumer behavior is a critical factor in the design and function of credit systems. Understanding how consumers manage their finances is essential for assessing credit risk. Repayment patterns, including consistency and timeliness, directly influence creditworthiness. Financial habits, such as spending and saving, provide insights into an individual's reliability. These behavioral insights are key determinants in making informed lending decisions. Ultimately, consumer behavior shapes the accessibility and terms of credit for individuals. Trust forms the foundational principle of all credit relationships. This applies universally, whether between individuals or institutions. Credit fundamentally relies on the belief that a borrower will repay a debt. This principle remains constant despite significant technological advancements. Technology enhances credit assessment but does not replace the need for trust. Therefore, trust is an enduring and central element in the credit system. Credit functions as a social contract, built on mutual agreements and societal frameworks. Individuals agree to repay debts, upholding their commitment within this contract. Society provides mechanisms to enforce these repayment agreements, ensuring accountability. These mechanisms also manage the inherent risks associated with lending and borrowing. Responsible credit use is essential for financial well-being. Ongoing education plays a crucial role in promoting this understanding. It helps individuals grasp the fundamental principles of borrowing. Education clarifies the benefits associated with judicious credit management. It also highlights the potential pitfalls and risks of irresponsible borrowing. This knowledge empowers individuals to make informed financial decisions. The credit system is fundamental to modern economies, enabling various financial activities. It facilitates a continuous cycle, starting with the borrowing of funds. These borrowed funds are then utilized for spending, stimulating economic activity. The cycle concludes with the repayment of the borrowed amount, often with interest. The credit market is a dynamic sector, constantly evolving to meet new demands. Innovation drives the introduction of new credit products and services. These innovations are primarily fueled by changing consumer needs and preferences. Advancements in technology also play a crucial role in shaping new credit offerings. New products aim to provide more flexible, accessible, and tailored financial solutions. This continuous evolution ensures the credit market remains responsive and competitive. Credit systems are fundamental components within the broader financial landscape. They are not isolated, but deeply interconnected with other critical financial sectors. This interconnectedness means credit systems both influence and are influenced by these sectors. One key sector is banking, where credit availability impacts lending and economic growth. Investment sectors also interact with credit, as financing often relies on credit markets. The insurance sector is another interconnected area, influencing risk assessment and capital flows. A well-regulated credit system is fundamental for economic stability. It plays a crucial role in preventing financial crises within an economy. Such a system is essential for fostering sustainable economic growth. Effective credit management ensures the smooth flow of capital. This contributes to overall economic resilience and prosperity. Credit is a fundamental component of effective personal financial planning. It significantly influences major life decisions, such as securing home ownership. Credit also impacts access to educational opportunities and funding. Furthermore, it plays a crucial role in long-term financial goals, like retirement savings. Access to credit is fundamental for businesses to operate effectively and sustainably. It provides the necessary capital for day-to-day operations and strategic expansion. Credit also fuels innovation, allowing businesses to develop new products and services. This financial support directly contributes to the creation of new employment opportunities. Ultimately, robust business credit is a key driver of overall economic development and prosperity. Governments play a multifaceted role in the functioning of credit markets. One key function is acting as a regulator, establishing rules and oversight for financial institutions. This regulatory role ensures fairness and transparency within the credit system. Governments also serve as lenders, providing credit directly through various programs. Additionally, they act as guarantors, backing loans to reduce risk for private lenders. These roles collectively aim to maintain stability and ensure broad access to credit. Technological advancements have profoundly reshaped the landscape of credit accessibility. These innovations enable significantly faster credit approval processes. Technology also facilitates a broader reach, extending credit to a wider demographic. However, this increased accessibility is accompanied by the introduction of new risks. Balancing innovation with risk management is crucial in the evolving credit market. The stability of national credit markets is a critical factor for global economic health. Credit markets facilitate lending and borrowing, essential for economic activity and growth. Disruptions in these markets can lead to financial crises within a nation. Such crises are not isolated. They can rapidly spread across international borders. Interconnected financial systems allow economic instability to become a global issue. Therefore, monitoring and maintaining healthy national credit markets is vital for global economic stability. Credit risk assessment has undergone significant evolution over time. Initially, assessments relied on subjective character judgments of individuals. Today, it involves complex algorithms and vast data sets. These advanced methods predict repayment likelihood with greater accuracy. Consumers possess fundamental rights concerning credit reporting and financial interactions. These rights ensure access to fair and accurate credit information. They also protect consumers from discriminatory lending practices. Alongside these rights, consumers bear crucial responsibilities. These include prudently managing personal debts and financial obligations. Consumers must engage ethically with the credit system to maintain its integrity. Credit regulation is a dynamic field, constantly evolving to address new financial landscapes. It must adapt to the emergence of innovative financial products and services. Technological advancements, such as AI and blockchain, also necessitate regulatory adjustments. Furthermore, credit regulation responds to ongoing economic challenges and market shifts. The primary goal is to strike a delicate balance between fostering financial innovation. Simultaneously, it aims to ensure robust protection for consumers and market stability. Responsible credit use is a powerful tool for wealth building. It enables individuals to acquire significant assets. Credit facilitates investments in future growth and opportunities. Strategic credit management can enhance financial stability. Leveraging credit wisely contributes to long-term financial prosperity. The digital age introduces significant challenges to traditional credit systems. One major concern is the heightened risk of cybersecurity threats. Data privacy is another critical issue, demanding robust protection measures. Regulatory frameworks must continuously adapt to these evolving digital landscapes. These factors necessitate ongoing innovation in credit management and security protocols. Credit scoring models assess an individual's creditworthiness, crucial for financial decisions. While FICO is a dominant model in the United States, its global application is not universal. Other countries have developed their own distinct credit scoring systems. These models reflect diverse legal frameworks and unique financial cultures worldwide. Access to credit significantly impacts social mobility, offering pathways for economic advancement. Credit provides individuals with capital to invest in education, skills, training, or business ventures. These investments can lead to higher-paying jobs, entrepreneurial success, and increased income. Improved economic circumstances enable individuals to move up the social and economic ladder. Thus, credit acts as a crucial tool for enhancing opportunities and fostering upward social mobility. Credit information is not static. It is a dynamic record of an individual's financial activities. This information is continuously updated with every new transaction initiated by the individual. Payments made towards existing debts also contribute to the ongoing evolution of credit data. These constant updates reflect the individual's current and historical financial behavior. The dynamic nature ensures credit information accurately portrays an individual's financial standing. The credit system is designed to facilitate financial transactions and economic growth. A primary objective is to provide broad access to credit for individuals and businesses. This access enables investments, consumption, and various financial activities. Simultaneously, the system aims to encourage responsible borrowing practices. It also promotes responsible lending by financial institutions. This balance prevents systemic issues, ensuring stability and sustainability within the economy. Credit is a fundamental pillar of modern commerce. It underpins a vast array of transactions within the economy. Credit facilitates crucial investments across various sectors. It is essential for driving economic activity. Credit enables the flow of capital, supporting growth and development. Establishing business credit is crucial for a company's financial health and growth. The foundational step involves creating a distinct legal entity, such as an LLC or corporation. This legal separation is vital for differentiating personal and business finances. It ensures that business credit is built independently, protecting personal assets. An employer identification number, EIN, is a unique tax ID issued by the IRS. It is crucial for businesses, serving as their federal tax identification number. Possessing an EIN enables businesses to open dedicated bank accounts. It also allows businesses to apply for credit and fulfill various tax obligations. Opening a dedicated business bank account is a crucial step for any enterprise. It provides a clear and essential separation of business funds from personal finances. This distinction is vital for accurate financial tracking and management. A business account helps establish a formal financial history for the company. This history is critical for securing loans, credit, and investment opportunities. It also simplifies tax preparation and ensures compliance with financial regulations. Registering with major business credit bureaus is crucial for tracking credit activity. Key bureaus include Dun & Bradstreet, Experian Business, and Equifax Business. This registration enables businesses to have their credit history reported. It ensures that credit transactions and financial behavior are formally tracked. Vendor credit, also known as trade lines, is crucial for businesses. It involves establishing accounts with suppliers. These suppliers report payment history to business credit bureaus. This reporting mechanism helps in building a strong business credit profile. Applying for a business credit card is distinct from personal credit applications. It enables a company to incur expenses directly under its own name. This process allows the business to establish its own credit history. A positive credit history is built through punctual payment of all incurred expenses. Maintaining impeccable financial records is crucial for any business seeking external financing. These records serve as direct evidence of a company's financial health and stability. Lenders and creditors meticulously review these statements to assess creditworthiness. Demonstrating strong financial health is a prerequisite for securing substantial credit and loans. Maintaining a strong business credit score is crucial for financial health and future opportunities. A key factor influencing this score is the business's payment history. Consistently paying all invoices and debts on time is paramount. Timely payments demonstrate financial responsibility and reliability to creditors. This practice significantly contributes to building and maintaining a positive credit profile. Conversely, late payments can negatively impact the credit score, hindering access to financing. Credit utilization is a key factor in assessing a business's financial health and creditworthiness. It measures the amount of credit a business is currently using compared to its total available credit limit. Maintaining low credit utilization, ideally below 30%, is crucial for a strong credit profile. This practice demonstrates responsible credit management and financial prudence to lenders. A low utilization ratio positively impacts a business's credit score, signaling reduced risk. Conversely, high utilization can indicate financial strain, potentially lowering credit scores and increasing borrowing costs. Regularly monitoring business credit reports is crucial for financial health. This practice helps in promptly identifying and rectifying any inaccuracies or errors. It also serves as a vital defense against potential fraudulent activities. Consistent oversight ensures the accuracy and reliability of the credit profile. Maintaining an accurate credit profile is essential for securing favorable business terms. Applying for a small business loan can be a strategic financial move for enterprises. Successful repayment of the loan demonstrates creditworthiness to lenders and financial institutions. This process helps to build and strengthen the business's overall credit profile. A strong credit history is crucial for future financing and business expansion opportunities. A business line of credit offers flexible access to capital for various operational needs. It functions as a revolving credit facility, allowing businesses to borrow, repay, and reborrow funds. This financial tool is crucial for managing cash flow fluctuations and unexpected expenses. Responsible utilization involves borrowing only what is necessary for business operations. Timely and consistent repayment of the borrowed amounts is essential. Proper management of a line of credit positively impacts a business's credit score and financial standing. Equipment financing allows businesses to acquire essential assets without large upfront capital. It provides a strategic method for obtaining necessary machinery, technology, or vehicles. Businesses make regular, scheduled payments for the financed equipment over a set period. These consistent, on-time payments are crucial for building and improving business credit scores. A strong credit history can lead to better terms for future loans and financial opportunities. Thus, equipment financing supports both asset acquisition and long-term financial health. Commercial real estate loans represent a significant financial commitment for businesses. Effective management of these loans can substantially enhance a business's credit profile. The substantial nature of the commitment demonstrates financial stability and reliability. Consistent and timely repayment of these loans is crucial for credit improvement. This practice builds a strong credit history, benefiting future financial endeavors. Financing business vehicles is a strategic financial decision for companies. These loans contribute positively to a business's credit history. Consistent repayment of vehicle loans demonstrates a business's ability to manage installment debt. A strong repayment record enhances the company's overall creditworthiness. Businesses often utilize credit to acquire inventory from suppliers. This strategy is particularly beneficial when suppliers report payment activities to credit bureaus. Timely repayment of these credit-based inventory purchases is crucial. Consistent on-time payments positively impact the business's credit history. This practice effectively enhances the overall credit standing of the business. Businesses often utilize various funding methods to launch and sustain marketing campaigns. One such method involves leveraging business credit for campaign financing. This strategy allows companies to access necessary capital for growth initiatives. Diligent repayment of these credit-funded campaigns is crucial. It demonstrates a business's effective management of short-term debt obligations. Successful management of business credit enhances financial credibility and growth potential. Investing in technology upgrades can significantly enhance operational efficiency for businesses. Utilizing credit facilities provides a viable pathway for funding these essential technology investments. Responsible and timely repayment of these credit facilities is crucial for financial health. Such responsible repayment practices directly contribute to strengthening the business's overall credit score. Businesses may utilize credit for payroll during lean periods to maintain operations. This strategy ensures employees are paid, preserving workforce stability. Prompt repayment of the credit demonstrates financial resilience. It also reflects responsible and effective cash flow management practices. Financing franchise fees or initial startup costs is a common practice for new businesses. Utilizing business credit for these expenses can help establish an early credit history. This benefit is contingent upon strict adherence to the agreed-upon repayment schedule. Consistent and timely payments are crucial for building a positive business credit profile. Strategic credit use is vital for optimizing supply chain purchases. This includes leveraging bulk buying opportunities with favorable credit terms. Such practices lead to significant cost savings for businesses. It also helps in building stronger credit relationships with suppliers. Securing credit is crucial for business expansion projects, such as opening new locations. This financial backing indicates a business's strong growth potential and future viability. It demonstrates the business's capacity to manage larger financial commitments effectively. Such funding reflects confidence in the business's ability to scale and succeed. Research and development, R&D, drives innovation and future growth for businesses. Funding R&D initiatives is crucial for maintaining a competitive edge in the market. Businesses often utilize credit facilities to finance these significant investments. The successful repayment of such credit demonstrates financial responsibility. It also signals a strong commitment to long-term strategic development. This approach highlights a business's dedication to innovation and sustained progress. Using credit to cover legal fees for patent applications is a strategic financial move. This approach applies to various intellectual property protection efforts. It allows businesses to finance the safeguarding of their intangible assets. This practice helps establish a credit history tied to a business's intellectual property. Establishing utility accounts in a business's name is a key operational step. Prompt payment of these utility bills is crucial for financial management. This practice can positively influence a business's credit profile. Certain commercial providers may consider utility payment history in credit assessments. Engaging professional services, such as legal or accounting, can impact credit history. This occurs when these services are utilized on credit terms rather than upfront payment. Crucially, these credit arrangements must report to credit bureaus. Reporting to bureaus allows the payment history to be recorded and evaluated. This strategy can diversify and strengthen one's overall credit profile. A strong business credit score is crucial for financial health and future opportunities. Requesting credit limit increases on existing business credit lines can be a strategic move. This action demonstrates to lenders that the business has the capacity to manage more credit. Crucially, maintaining low credit utilization after an increase is vital for positive impact. Together, these practices can significantly improve the business's overall credit score. Debt restructuring involves proactively negotiating with creditors to modify existing debt terms. This strategic approach is crucial for preventing potential financial distress and insolvency. Successful restructuring helps avoid negative impacts on an individual's or entity's credit score. Ultimately, it aids in maintaining financial stability and long-term economic health. Improving a credit score requires a structured, long-term plan. This plan focuses on key metrics that influence creditworthiness. Payment history is a critical factor, emphasizing timely payments. Credit utilization, the amount of credit used versus available, is another vital metric. Adhering to this plan ensures sustained financial health and an improved credit score. A strong business credit profile is crucial for attracting investors. It signals a company's financial stability and reliability to potential investors. Such a profile demonstrates responsible financial management practices. This enhances the business's overall appeal and trustworthiness. Ultimately, a robust credit profile can significantly improve investment opportunities. Forming successful business partnerships requires trust and reliability between collaborators. A strong business credit history is a key indicator of a company's financial health and stability. It demonstrates a business's ability to manage its financial obligations responsibly. This reliability can lead to more favorable terms in partnership agreements. Therefore, a solid credit history is crucial for attracting and securing valuable business collaborations. Government contracts offer lucrative opportunities for businesses. Securing these public sector opportunities often requires specific qualifications. A strong business credit rating is a critical factor for eligibility. This rating demonstrates financial stability and reliability to government agencies. Paying business insurance premiums is a critical financial obligation for companies. Utilizing credit for these payments can offer flexibility and strategic financial advantages. Effective management of these credit-based premium payments is essential. Proper management can positively contribute to a business's overall financial reputation. Managing business software subscriptions on credit can impact financial standing. Timely payments for these subscriptions are crucial for credit building. Consistent on-time payments can establish microcredit lines. These microcredit lines are often reported to various credit bureaus. This process can positively influence a business's credit profile and access to future financing. Business credit cards are essential tools for managing company travel expenses efficiently. Using these cards for travel expenditures centralizes financial tracking and simplifies expense reporting. Prompt reimbursement of these expenses is crucial for maintaining healthy cash flow within the business. Timely payment of credit card balances is vital for avoiding interest charges and fees. This practice reinforces responsible credit behavior, benefiting the company's financial standing and credit score. Sponsoring industry events offers a strategic opportunity for businesses to enhance their market presence. Utilizing business credit for event sponsorship can be a key financial strategy. Timely repayment of this credit demonstrates robust financial capacity and reliability. This practice not only boosts a brand's visibility, but also reinforces its financial standing. Thus, event sponsorship, when managed with credit, serves dual objectives of marketing and financial proof. Employee training and development programs are crucial for human capital growth. Funding these programs can be achieved through various financial mechanisms, including credit. Utilizing credit for training signifies a strategic investment in the workforce. Effective management of repayments demonstrates responsible financial planning. This approach highlights a commitment to both human capital development and sound financial practices. Franchise expansion often involves leveraging credit to finance new locations. Successfully managing finances across multiple franchise units is crucial. Demonstrating this financial management capability enhances the business's creditworthiness. A strong credit standing is vital for securing future funding and growth opportunities. Strategic expansion through credit, when managed well, significantly strengthens the overall business. A robust business credit profile is crucial for successful mergers and acquisitions, M&A. It provides access to the necessary capital required to finance these complex transactions. A strong credit history demonstrates financial stability and reliability to potential lenders. This allows companies to secure more favorable terms and lower interest rates on loans. Favorable terms reduce the overall cost of acquisition, enhancing profitability. Ultimately, a strong credit profile streamlines the M&A process and strengthens deal outcomes. International trade often necessitates specialized credit instruments to facilitate cross-border transactions. These instruments are crucial for managing financial risks inherent in global commerce. A strong credit history is a fundamental prerequisite for accessing such financing options. Lenders rely on credit history to assess the borrower's reliability and repayment capacity. Establishing a robust credit profile is vital for securing favorable terms in international trade finance. Supply chain finance programs optimize supplier payments. These programs leverage a business's credit standing. Participation enhances the business's cash flow. It also strengthens credit relationships with suppliers. Asset-backed lending is a financing method where businesses use their existing assets as collateral for loans. This approach allows companies to secure capital by leveraging tangible or intangible business holdings. Common assets used as collateral include accounts receivable, inventory, machinery, and real estate. The value of these assets determines the loan amount and provides security for the lender. Beyond providing immediate capital, structured repayment of these loans helps build business credit. This financing mechanism is vital for businesses seeking liquidity and financial growth. Factoring accounts receivable involves selling invoices to a third party. This process provides immediate cash to a business, improving liquidity. While not directly building credit, it significantly enhances cash flow. Improved cash flow enables businesses to make timely payments to suppliers and creditors. Consistent timely payments are crucial for maintaining a positive payment history. Thus, factoring indirectly supports and strengthens a business's overall credit health. Merchant cash advances, MCAs, offer businesses quick access to capital. These advances are typically repaid through a percentage of daily credit card sales. While MCAs can be costly, they provide short-term liquidity for urgent needs. Judicious use means carefully evaluating the need and repayment capacity. Prompt repayment is crucial to mitigate high costs and avoid financial strain. If reported, Successful repayment can positively contribute to a business's credit history. Corporate bond issuance is a key financial strategy for established businesses. It serves as a significant method for companies to raise substantial capital. These bonds are debt instruments issued by corporations to investors. Investors lend money to the corporation in exchange for interest payments. Successful issuance can enhance a business's credit reputation in financial markets. This process solidifies trust and future borrowing capacity for the issuing company. Revolving credit facilities offer continuous access to funds, distinct from traditional term loans. These facilities are established with banks, providing a pre-approved credit line. Borrowers can draw, repay, and redraw funds up to a specified limit. This flexibility allows businesses to manage working capital and unexpected expenses efficiently. Responsible use of revolving credit consistently builds and strengthens creditworthiness. It is a valuable financial tool for maintaining liquidity and supporting operational needs. Proactive engagement with credit rating agencies is crucial for financial strategy. Understanding their assessment criteria allows entities to tailor their financial reporting. This interaction helps in identifying areas for improvement in financial health and transparency. Improved credit ratings can lead to more favorable borrowing terms and lower interest rates. Ultimately, better ratings open doors to more substantial and diverse financing opportunities. Financial advisors play a crucial role in developing effective credit strategies. These consultations aim to optimize the utilization of all available credit resources. A comprehensive credit strategy ensures efficient management of financial obligations. It involves analyzing current credit standing and future financial goals. The objective is to maximize benefits while minimizing risks associated with credit. A diversified credit portfolio involves holding various types of credit instruments. This includes revolving credit, such as credit cards and lines of credit. It also encompasses installment credit, like mortgages and auto loans. Such diversification demonstrates strong and broad financial management capabilities. Long-term financial planning is crucial for sustainable business growth and stability. A key component of this planning involves strategic credit building. Integrating credit building ensures consistent access to necessary capital. Strong credit facilitates favorable lending terms and investment opportunities. This sustained access to capital enables strategic business expansion and innovation. Ultimately, it enhances a business's financial resilience and adaptability in the market.